So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and today I'm joined by John Bogdasarian. John is a highly successful real estate investment and development professional with more than 25 years of experience. He started Promanas Group with 9 initial investors, raising $1 million for his first deal. He's the author of Do the Work Once, Get Paid Forever. Investing in a broad real estate portfolio has taught John the skills needed to achieve his goal of creating value for tenants and investors. Promanas currently has ownership in multiple entities with more than 3 million square feet of property. John has acquired and or developed more than $500 million in real estate assets nationally. John, welcome to the show.
Thanks for having me.
Absolutely. Obviously an incredible resume. You sent me the book, which I'm very grateful for. Thank you. It was a great read. But let's kind of start at the beginning. How did you even get into all of this? Did you start in the corporate world or?
No, I actually started as a residential real estate agent. So I worked for a developer out of college selling condominiums in an on-site sales office for a golf course community here in Ann Arbor. I did that for a couple of years and then got my residential real estate license and kind of went out on my own. Not really on my own. I had mentors and I hired coaches and I had very high residential real estate production very quickly. And so then I started buying single family homes as rental properties. I never really wanted to be a real estate agent. I just kind of wanted to learn a skill. And so really, I didn't want to work at all. So I started buying rental properties with the idea that other people would pay me rent and I wouldn't have to work. And so I think it was like 98, I bought my first rental in 96, and then I bought a portfolio of homes in 98, and then grew that and then sold those, or sold some of them, I guess, before 2007. And then when the market crashed, I guess the first time I took on outside investors was in 2005. And we bought a student housing portfolio in South Bend that housed about 480 Notre Dame students. That was a great deal. We sold it in 2007. Everybody doubled their money. It was really a good deal. I had, I think, 7 investors in that deal. That was the first time I'd taken on outside capital. And then, then 2007 and 8 happened. And so we kind of sat around and waited. And in 2009, I started aggressively buying industrial buildings and multi-tenant office buildings here in Michigan. And so we built that portfolio up to around 3 or 4 million square feet of space that ended up having, just by word of mouth over the years, from 2009 to about 2016 or 17, we built that up to around 300 accredited investors. And then we actually sold that. The first half of the portfolio we sold pre-COVID for, I don't know, $100 million or something. And then we sold the second half of it just at the end of last year and closed that portfolio out. We kind of made the decision a couple of years ago that we either had to be very good at managing and running properties and running the ground up development for the development projects that we started doing, or we had to be more pure private equity capital. And we just decided, with the labor shortage and the lack of my consistency to show up on a regular basis, to be honest with you, that it just wasn't the best for us to be operational people in terms of running and managing a portfolio. So we've literally sold all of our assets, and now we are purely a private equity company with some 400 or 500 accredited investors. We're now well up over $1 billion of assets that we have either under construction or we have ground up developments all over the country now. So, and we're not, I mean, I say we're just the money, but we actually, because of the experience, we put another layer of due diligence and try and bring value to the equation for people. So I know that this shows a lot about syndicating, and I've helped a lot of people become real estate syndicators. And there is this this balancing act of kind of managing investors' expectations, reporting to investors, dealing with investors, and then running the project and making sure it comes out successful. And that's tricky to do. You can do both. We did for a while. We just decided that's not really in our best interest. It's better for us to see hundreds of deals across the country being sent to us from, I guess, developers that don't want to deal with the money side. I've just found most people are passionate about the highest and best use principle. If you pay attention, if you subscribe to that, most of us in this business drive around and we just look at things and we think, what could go there? What could go there? What could go there? I do it too. I mean, I do it all the time, but then I'll call somebody and say, hey, you're a developer. Why don't you, here's a piece of property, go figure out a plan for it. And then we'll just do the money. And so that's now the value proposition for us. And that's, I guess, fundamentally the core of everything I've tried to do is figure out how can I create value for people? Because if I can create value for people, I'm always going to have business and I'm always going to, do okay. So originally as a real estate agent, I was always trying to teach people why it would be better to hire me to sell their property as opposed to selling it for sale by owner, and how I could actually net them more money from the sale of their home than they could by doing it on their own. And so I had a whole program designed to kind of explain why that makes sense and why there is value that I could create for them. Then in this world now, what we do is we say to developers, hey, if you don't have to deal with the headaches and hassles of money, you don't even have to think about it. You find a good project, send it to us. We write you a proposal. We can theoretically make them more money out of a deal than they can on their own. And then on our side for our investors, they have access to deals that have been thoroughly vetted by not just one party, but by two parties. And we're sort of like an independent verification source to say, we've background checked these developers, we've reviewed this deal, we've run we've really scrutinized the deal better than, I don't care how smart you are. If you're a doctor, you're spending all your time being a doctor, you can't really be great at evaluating real estate deals. So, that's kind of our role now and how we've morphed into what we do. And actually we've taken a step further. Now we do it with a company called Orange Seed Capital that we started. It's a venture capital or angel seed capital company that we invest in startup companies with.
Wow, that's awesome. And that's quite the progression that you guys have had from, sort of the syndication side all the way to, just focusing on development and now really just the private equity. So what is it about development and I guess just being on the money side of development that was so enticing for you guys to pivot and really focus on that?
I think for me, I really like the wiring the deal together side. I like the selling aspect of it. I like communicating with investors. I like making people good returns. And I'm a big believer in bricks and mortar stuff. Being a Gen Xer, I've always been kind of in the middle of everything, I guess. Born in 1970, I kind of remember when if you didn't know how to make a collect call from a payphone, you weren't talking to your parents, that's for sure. So, my generation and age group has seen so many different things that most of us, I think, tend to fall right down the middle. We're not a large percentage of the population, but I think, to be honest, if I look at things in perspective, I've always fallen down the middle. I'm not right wing. I'm not left wing. I'm not, I'm kind of fit this mold of, I'm not super pro tech. I'm not, we're into cryptocurrencies. I was seed capital to one of the largest NFT platforms in the world, the largest NFT platform now in the world. So I've made investments into things that I don't understand, purely to learn. And it's been, it's been incredible. And so I just feel like for me, I mean, to answer the question more specifically, I can learn a lot more by traveling to Denver, Texas, Nashville, Florida, Washington, D.C., Salt Lake City, all the places where Minneapolis, all the places where we have deals sent to us from, where they pass an initial screening process that we have. And then we have a phone conversation and see if there's a gel between, the what we call the boots on the ground, the deal sponsor, or however you want to refer to them, and us, if there's a blend there that makes sense and we can provide value to them, then I get to learn a lot more by going to these towns, seeing what's going on, seeing what's happening in the world. I can't tell you how many people tell me, this is a great example. I'll hear from somebody in, it doesn't matter where they are right now, Arizona, and they'll say, John, you won't believe it. Homes are unbelievably expensive here. Our home values doubled in the last year. I'm like, yeah, it's not just there. It's everywhere. And I know it's everywhere because I've been everywhere. And so for me to be able to see what's happening in the whole country is, I think, very valuable, and what I can theoretically bring to the equation. Plus it affords me the ability to kite surf or kiteboard when I want to go. And, it gives me a lot more flexibility. But more specifically, for me, it's never really been about the money. It's been about, what am I going to learn from this process? Is it going to be fun? Is it going to help people? And am I going to learn something from it? Those are really our criteria. And then, yeah, of course, we want it to make some money. It doesn't, I guess that's how you keep score. So, but I've been very fortunate. I've hit cycles right. I've seen things coming. And I think a lot of that has to do with the broad exposure I get across the whole market. I mean, this housing market is terrifying right now. Anybody who's not terrified to buy a house right now has lost their mind, because it's, these prices just can't, the price escalations just cannot be sustained. I mean, it doesn't make any sense. It makes sense in a supply demand constraint, but I don't want to get into the housing market too much, but it is an indicator of just about everything. I mean, I've always found it to be the biggest indicator of what's going on. So
yeah, kind of on that, you sold your first deal back in 2007. Did you foresee something coming, or was that just kind of, you got lucky that you sold right at the top there?
No, we were trying to get out of everything we could. I was trying to sell my single family homes as fast as I could. I was trying to get out of everything.
So you saw it coming.
Oh yeah, absolutely. I wasn't smart enough to figure out how to short the CMBS market. I mean, I just didn't possess that kind of knowledge at the time. Had I know how, but I was asking people, I was calling people, I was trying to figure out, how can I place this bet? I mean, I know where this is going. I had seen people that own 6 houses and, put deposits down on new developments. Like, it was crazy, and I was bailing those people out. Friends that were like, oh, I put deposit money down on 6 condos in Florida, and they're all going to go up in value by hundreds of thousands of dollars before I even have to close. This was the kind of stuff that was going on, where, exotic dancers, for lack of a better term, had, 8 mortgages in their name. It was crazy. And yeah, you can see it. If you pay attention to the single family home market and what's going around, it's hard to filter out, I think, the day-to-day noise and really see long-term trends. But I saw this one coming. I was like, we got to do every development we can, ground up, condo projects, everything else. I didn't see COVID coming. That one was a bit of a shocker. Yeah. But we built in enough, and unfortunately, some of our condo projects that we had at the time stalled out. We experienced delays. They took years longer than expected. And I think on some of those projects, because of the way we structure things, our investors came out very well. We didn't come out as well as we would have liked, but it's fine. Our investors still made the returns we originally projected. We were hoping they would be 20+% IRRs. They ended up being 12 to 15, which is fantastic, because the same amount of return, just over a longer period of time. And that's what I like to say about real estate, is it can experience setbacks, but they're usually temporary. And as long as you've built in enough margin for error, and enough reserves, and you're not over levering, then you can withstand all that stuff. And that's what I see happening now as the problem. That's your next question. Where are we going? Probably. And I think right now, everything is getting real thin, like the deals we're seeing don't have very much margin for error in them. And we call them layers of protection. We want layers of protection. So we want to see a 4 or 5% developer fee on a project, but we won't pay it all out throughout the project. We'll hold that back. We want to see a big reserve on the construction side and on the soft cost side. And sometimes we'll even pad the reserve by an extra $1 million or $2 million, depending on the deal size and what it is and where it is. And then we want to see, it's like a crime boss. He sits in the back corner of the room of the restaurant so he can keep his eye on the exits, right? Well, we want to know what our exits are. If we're building a for sale condo project, can we back into a rental number that makes sense if we get stuck with it, which happens? Our hotel in Denver, which is a business extended stay travel hotel. I mean, it was killing it. It was open for 4 months. It was absolutely crushing it. And then COVID hits and our occupancy drops to 5%. Nobody can underwrite that, so, but we have the ability to go to the lender and say, look, they don't want the thing either, right? I mean, they're terrified. They're like, oh, what do we do? And I said, well, look, we'll just pay the loan down by $10 million and, we'll just put extra equity in and pay it down. We don't have a limit to our capital. And that's very safe capital. I can go to my investors and I can say, look, I have 10 million available. It's going to go in as pref equity and it's going to get an 8% yield on it, preferred to everything. And it's exceedingly safe because we know the hotel costs 50 million to build. And when we pay down 10 million, we're only on 20 million on it. And we know occupancy will come back. And sure enough, 21, we were up 100% over 2020. And this year we're trending up 45% over 21. So we'll almost be back to our original projections, I think, by the end of this year. And that now it's cash flowing, like mad. So we're still waiting to see if there's a third wave or whatever before we refi and pull our equity back out. But the yield's there. And in the long run, everybody's going to make a lot of money on that deal. It's just the illiquidity, which everyone needs to know about. And I think any up and coming real estate sponsor or syndicator, if you will, needs to be preparing their investors for these things. Like I would always tell my investors, look, if you have, let's say $3 million of capital to invest and, this is your bottom stack. So if you want to allocate $1 million to this, that's fine, but keep the $1 million liquid up top for your emergencies and your whatever. And so if you layer that financially and you don't have to sell in a bad situation, which we've had, we've had investors that have gotten divorced. We've had investors that have died and kids have inherited. We've had situations where people have lost their job and needed to liquidate their position in a non-liquid investment. And fortunately, we've always been able to get them out at par, usually par plus their preferred return because our deals are trending very well. But they're missing out, right? Because if the deal's is showing a 15 to 18% IRR projected and it's going on track, we're only going to be able to get them out at, say, their original capital plus maybe their 7% pref or 8, whatever it was on the deal, usually. And then, and we'll buy them or one of the other members in the group will buy them. But, I don't know, it depends on who's listening to this, but if you're an up and coming, deal sponsor, syndicator, whatever, I'd say keep that liquidity and prepare your investors for that, because none of us know what's going to happen with, the next wave of this or world war that or whatever. I mean, there's just so much going on in the world. It's insane.
It's true. Yeah. You made a lot of really great points. In case we do have a lot of new people listening, explain IRR. Yeah.
So IRR, your internal rate of return. I mean, I throw that around. We kind of, it's some of our deals, it's very hard to calculate an accurate IRR because we're distributing cash throughout the deal. These days, it's easier to calculate because mostly we're doing ground up developments. So you're putting your money in, but put in $100,000 And, if you were to get $200,000 back in 7.2 years, that'd be a 10% IRR. That's just the rule of 72. So that's really easy to do. If you, if you double your money every 7 years, 10 into 7, yeah. So 10%. So just a compounded annual rate of return on your money. I was always told by mentors and people that, real estate, if you can get a 10%, safe 10% annual rate of return on real estate deals, 10 to 12, that's really good. Investing in businesses, you should be able to get 20%, but there's obviously operational headaches there. And I'm not talking about investing in businesses through the stock market, because that doesn't yield, 20%. That's,
no.
Got a long-term average of what, 8 or 7 or who knows?
Yeah. 6 to 8.
Yeah. I mean, it doesn't, and I'd say we're usually more in that 12 to 14 range. And a lot of our deals have surprised wildly to the upside, and we've been real high on some of them, but I don't, that's not what we project. I mean, it's just, we're more preservation of wealth, make sure we don't lose money. Rule number 1, don't lose money. And rule number 2, follow rule number 1. I think that's a Warren Buffett quote.
Warren Buffett. Yep.
Yeah. So, that's our first and foremost position. And then, but we've had some that are very high. We had one that just wound up actually in Florida that was an 18% pref. And there was supposed to be some back end participation, but that all eroded due to COVID because the project took an extra year and a half. It experienced some other challenges too that we had to solve along the way that were quite tricky and sticky. But the good news for our investors was it was supposed to be a 20-month deal. I think it worked out to be like a 3-year deal. So they got 18% over a lot longer period of time, which is fantastic. Now, out the back end of that deal, there wasn't as much upside, which is where we get the lion's share of what we make, but that's okay. We did well on it anyway. And really, I'm in the business of collecting accredited investors and making them money. So if I do that, I always have this stable of capital to work with, which, to be honest with you, increasingly is becoming more and more my own capital, because we're now, it's amazing what happens as you start cycling out of these deals. You promote and you're right in, and you start realizing that. And so, originally when I was starting out, I might be able to put like, say, 50 grand in every deal, now I can put $1 million in every deal. And, so it just kind of starts to snowball. And you can either do bigger and bigger deals, or you can do more of them. And I think we've kind of hit our sweet spot on deal size, where we wouldn't really do things that are much larger than what we're doing. It used to be that raising $1 million to $2 million for a deal back when I started out was kind of a big thing to do. Now we, really don't do things that take less than 10 million, and usually they're up in the 20 to 25 million of equity range. So, but once you get above that, then you're talking institutional capital and a different level of headache, and you really have to be in unique markets that can support, that deal size.
Absolutely.
So the sweet spot for us seems to be deals between, anywhere from 30 million to 130 million.
So kind of along those lines, obviously really focus on development. What kind of, I guess, fail safes are you putting in your underwriting, or seeing in terms of, the fluctuation in cost of like the variability in cost of supplies and labor for these? Like, is there any way to kind of bake that in, or is that just kind of along what you were saying earlier, where you just got to have that sort of, maybe 4 to 6% margin of error?
We do have things, put in there, but, we mitigate risk in a number of ways. One, I become the managing member of the development entity, even though it's someone else's project. Like if you had a deal and you said, John, we need 8 million of capital for this deal, and here's the prospectus, and here's our pro forma and projections, and here's where it is and everything else, I would write you a proposal. But part of that proposal includes me being the managing and controlling member of that entity. And so people have to get comfortable with that. I'm not going to be looking over your shoulder. I just have to have control so that if you're not doing your job or if something's not going right, I can step in and there's no debate about what I can and cannot do. I don't like joint control. I don't agree with it. So I would either say, John, your deal looks great. It's small. It's not for all my team, but I'll put money in your deal and you run it, and I'll just be passive. If I really like your deal, that's fine. Or if it's big enough and it fits what we do in our group, I'd say, I'll do your deal. You'll be contracted as the developer. You'll run it. You'll handle everything. You'll go to the meetings. I hope I never have to go there, but I'm the controlling managing member. And my office also handles all the books, the accounting, the draws. We keep it all in real time. So essentially, we're really catering to the developer that wants to just go out and be the creative mind, has the vision, put the deal together, works with the general contractor. Usually they go out for their own financing, but if not, we help with that as well. We have a lot of, obviously financing relationships with, having done billions now in deals. So or I don't know if it's 2 billion maybe, but I should say at least over 1. So you got, a lot of times we borrowed and paid back. But yeah, I think, getting a gross maximum price with a reputable contractor. So we have, what we're called GMP contracts for the construction. So typically we don't really experience much in the way of cost overruns. We are doing a number of high-end single family homes in Denver right now. Those are experiencing cost overruns, but they're like, 100, 200,000 on a, what we thought would be a $2.5 million house that's selling for $3.5 million. So we just fund that ourselves. Like we don't really ever go out to our investors for extra capital and things like that. And we don't typically ever go back to a bank. We usually have enough, like I said, built into the system, but gross maximum price contracts, background checks on anybody and everybody that's involved in the project. There's just a lot of things we put in our due diligence list that I think other people wouldn't, think of or do, because we've seen so many deals, and that's kind of part of the whole thing, right? Like if my whole motivation is to learn, then it's way better for me to just be the equity side, because now I'm going to see hundreds and hundreds of deals, and I'm going to be seeing them all over the country and see what's going on in various asset classes. As opposed to if I just have my one deal, and it's here in my hometown, and this is what I think is going to happen. How much am I really learning about lenders and contractors and architects and that kind of stuff?
Makes perfect sense. We are coming close. I do want to touch on one thing, a bit of a pivot, but I am curious what led to the decision to get into venture capital.
Oh yeah, that's an interesting story. I had a friend that started a company, went through the Y Combinator program, and they started a stem cell banking company. It's called Forever Labs, and so you can go in and they basically get your stem cells out of your bone marrow, and they cryogenically preserve your stem cells, and so you have a version of your younger self banked. And so let's say I have a knee replacement or a knee problem or whatever, they can take these stem cells, clean them up, give you your young stem cells, multiply them, grow them or whatever, shoot them into your knee, and boom. I mean, the regenerative medicine and what's going on. And I don't know if the younger generations have ever, like one of my coaches and mentors early on in life was Tony Robbins, back when I was in my 20s and late 20s, early 30s. And it's a long time ago. And I met Tony on a number of occasions. And now his latest book called Life Force is all about, like most of us as we get older, you're not there yet, but when you get into your 50s and 60s, you start focusing on longevity and, trying to stop aging and things like that. So using fancy filters on the computer system. But so in all seriousness, there's just so much going on in this arena. And my buddy's got this company, and I said, hey, can I get in 50 grand? And he's like, really? And I'm like, yeah. He's like, yeah, absolutely. And so I invested in his company, and And I started learning a whole lot about it. I kind of took on an advisory role with them and just tried to help any way I could. And then, and that company's doing real well, but he and his business partner, Mark, who's the science guy behind Forever Labs, they came to me and said, hey, we don't really know how to put a fund together, but we want to invest in companies coming out of Y Combinator. Can we do that? I'm like, sure. You know, I know how to do that. That's easy. You can syndicate anything, right? So we put a little fund together between the three of us, and there were 4 other members in it other than the 3 of us. And we invested in a bunch of companies in Y Combinator. I had no idea what they were. Those guys went out there and did it. I was like, you pick the companies, I'll run the books and accounting and back end stuff. And that was back in 2018. And I think we invested in like 14 companies. I think 3 or 4 of them are dead. A batch of them are doing pretty well. And then we have, I think 3, maybe 4 unicorns, they call them. They're worth billions.
Yeah.
Yeah. And when you invest at startup seed capital valuations and they go to billions, you're making, I mean, the returns are insane. And it's not a predictable formula by any stretch. Like, I would never put investors in deals like that myself. I don't aspire to run a VC fund. I don't need to. I don't really need to do anything anymore now, but it's more, I get to talk to all these founders who are now, a couple of them are billionaires on paper, you know, and it's like, so I'm talking to a guy in India, I'm talking to guys in New York City, I'm talking to, and so I'm learning all about this stuff. This is the most important thing to me, is that I'm learning about all these crazy things going on and all this amazing stuff going on. And I'm actually able to help connect them, link them. I connected one of my companies, which is a text messaging platform for the hospitality industry and sporting events and venues. And now I've connected him to all kinds of people and into these non-fungible token platforms. You know, I don't know if you've heard of the Bored Ape Yacht Club or CryptoPunks and that kind of stuff. It's not really my generational stuff, to be honest with you, but it's fascinating. And, you know, it's like I said, I wouldn't like drop what I'm doing and dump all my money in it. I mean, I fortunately didn't have to invest very much in this stuff at all to now have a lot of funny money to play with in that arena. Nice. So it's, you know, for me, it's more, I've got 4 kids. I don't want to become obsolete. I sort of want to know what, you know, is going on in the world. And, you know, it's fun to do. So that's how we stumbled into it.
Yeah. Tom Brady just bought a Bored Ape for like a little over, I think it was just a little over 350K. So yeah, I mean, unless you live under a rock, you've at least heard the term NFT, you know, whether or not you know about the Bored Ape and the crypto punks and all that is another story. But yeah, I mean, I've tried to get in on a few of the initial launches on some bigger projects. Steph Curry had that one he did for when he broke the record for 3-pointers. So I've tried to get in on some of that stuff. But again, you know, like I don't quite have the funny money that you have yet, but we're on our way. So.
Well, I mean, honestly, it's, I have a whole coaching platform now that I'm developing, and a second book that I'm writing about this life plan that I created for myself over the years. I hired the best coaches and mentors I could possibly find in my 20s, even when I couldn't afford to do it. I mean, I was paying my scripts and dialogues and sales coach $2,000 a month just to coach me personally when, you know, and he was out in California, a guy by the name of Mike Ferry. And then I had a business mentor who owned my brokerage, who was one of the top 10 real estate agents in the entire United States. And so I spent a lot of time, energy, and dollars in this, like creating this sort of map for myself in this life plan, which I really need because I'm wildly ADD. And if I don't have something to refer back to, you know, I'll just spin out. So I need a plan in order to have something to follow. And I think everybody does. But, you know, through this plan, I've actually, everything I've ever written in there. I mean, I've put the craziest stuff in there, things that getting my pilot's license, getting my instrument rating, buying my own plane, you know, a house in Turks and Caicos. I mean, you name it. I've put the craziest stuff in there, and everything has happened. Everything. I mean, it's like osmosis. It's just, if you write it down, right? You refer back to it. So this life plan, I've given this to gobs of people and over the years. And this is kind of, and I'm sorry to go over, but this is what's really important to me right now is this. I sent an email out to like 10 people that I had sent this plan to years ago. And I sent them a copy of the plan that they filled out originally, because I have people fill this out and send it to me. And so they sent it to me, and I found a folder on my computer that had all these old life plans from these people that I hadn't touched base with in years. And so I sent them a plan that they put together maybe 5 years ago or something. I said, hey, I'm just wondering how everything's going. Are you still using this plan? The responses are insane. I mean, insane. Every single one of them was like, I mean, one guy was this was one of the best ones. He was an emergency medicine, emergency room doctor, physician, gone to medical school, spent a ton of money, done all this stuff, right? Now he has like 140 rental units. He quit being a doctor. He's teaching other people. He has investors. He's like, and he's accomplished everything on his goal. He's like, I work like 4 hours a day tops, and I love it. He's like, I love what I'm doing and everything else. He's, he hated, I don't know if you've ever been to an emergency room, but when you get pulled into the bowels of a hospital, no windows, no nothing. I mean, you're living in there. And my family's all medical. My brother-in-law is an emergency room doc, and I have such respect for them, and I appreciate them so much. But at the same time, it's like you're in there and you're like, wow, so to see these transformations take place really opened my eyes to something. So I started a second book. I hope to have it done in the next couple months. I call it like a book, but it's more like a manual and then it'll have a copy of this life plan, which is really like a glorified Excel spreadsheet with multiple tabs on the bottom. And then you design it and put what you want in it. But there's a psychological effect to it that absolutely kind of compounds over time and keeps you on track. And so that's what I'm really fired up about right now. I mean, awesome. And we'll keep doing these deals too. That's fun.
Of course. Well, I look forward to that. I know that'll be incredible. And, that's sort of that power of like, putting the energy out into the universe and, sort of asking for things. As long as, you're doing the right things, you pretty much are always going to get what you want, which is a pretty incredible thing to tap into if you can do it correctly. But I do have 5 questions at the end that I ask all of my guests. It's the final 5. I'm really actually excited for your answer to the first one. What's the best advice you've gotten from a mentor?
Ooh, there's a lot of it. I mean, there's so many, but the first ever advice I got was from Don Chisholm, and he was the developer I worked for. And I probably got other stuff from him, but he said, show up, pay attention, and be on time, and you will be ahead of 98% of the rest of humanity. And back then, at my age and coming out of the University of Arizona with a 2.01 GPA, barely graduating, in 1994 or something, that was the advice I needed. And, so that was, fundamentally, that's all you have to do is show up, pay attention, and be on time. And if you're doing that, you're going to learn. But I don't know if I ever heard this, but what I always tell people, the best advice I give, I think, is don't work for money. Work because you're passionate about what you're doing and you're learning something, and you're going to go a long way. But I mean, like I could credit Bob Bolin with a bunch of advice, Tony Robbins, Mike Ferry. I mean, I've sought out books, there's gobs of books.
Love that. What is it about your career that makes you feel like you're fulfilling your why?
Well, I think like with most people that comes and goes. It's kind of fits my mindset. It allows me to do what I want to do when I want to do it. I have a lot of freedom. I think, like I said, I've had this roadmap. So I kind of planned it out so that I would have the time to coach my kids' baseball teams, drive them to school in the morning, pick them up in school in the afternoon. Those kinds of things I designed into my life. And real estate's just a mechanism. It's not, I'm not terribly passionate about, a building or whatever. This stuff comes and goes. I try and keep perspective and stay a little existential on the why, I think. Would I rather be exploring outer space and flying missions to Mars? Sure. But I don't have Elon Musk's mindset and temperament. Would I rather be, I don't know. I kind of, there's all kinds of things you think you want to do, but are you willing to put in the work to do them? This is just the one that kind of, I was willing to put in the work. I could kind of see the next step, and I'm a very sequential thinker. So I could just kind of see the next step.
Absolutely.
I don't know if that's a good answer or not, but
no, it's a great answer.
Sometimes
it makes perfect sense, because as you go through life, your why changes,
Yeah. Sometimes I want to be Denzel Washington.
So on. What's that?
Sometimes I want to be Denzel Washington or Tiger Woods or, the grass is always greener, right? And
of course.
So
absolutely. What's your favorite non-real estate or investment related book?
Boy, I got to say, I liked Atlas Shrugged a lot by Ayn Rand. That's an old book. Fountainhead was the second one I think I read by Ayn Rand. And then I think, Think and Grow Rich it's not real estate, but it is kind of like a business book.
No, that counts for sure.
There was The Art of Loving by, I think it's Eric Fromm, maybe, or Ethan Fromm, Eric Fromm. That's totally not business. And that book I've read a number of times over the years. So there's a couple.
If you could have any superpower, what would it be?
Superpower? Like a superhero kind of thing. I
get all kinds of answers to this question. That's why I really like it. Like someone said they wish their superpower was underwriting. So
underwriting?
Yeah. They wish that they were like the best underwriter. So you get all kinds of.
Honestly, I think if I could possess the skill of communication and global leadership in some capacity, I would like to affect change on the entire world if I could. It's so sad to me to see the extremes right now on both sides. I mean, left, right, I don't care which. I just don't like extremism. I don't think it makes any sense. It's illogical. I don't understand it. I don't understand war. I grew up in the Cold War era. We used to do drills under our desks in elementary school. We had to hide under our desk for a nuclear bomb. And then they showed us pictures of a nuclear bomb going off. And it was like, yeah, hiding under a desk is really going to help from that one.
Yeah.
But humans are a weird species. I mean, we don't do well with contentment and complacency and just being, a simple man, as Leonard Skinner would say. That's a tough thing to do for a lot of people. And I don't know why people gravitate towards the far reaches of one side or the other, or get so negative and opinionated on things. But if I had a superpower and I could wave a magic wand and get people together in more of a common goal, that would be it. If there is such a thing.
That's awesome. No, that you nailed it right on the head. We could do a whole episode just on that for sure. And last one, what's the best way for people to get a hold of you and learn more?
I think IR at Promanas.com, Promanas rhymes with bananas, is usually the best. And I mean, you can Google us, our website, Promanas.com. And I think we even have orangeseedcap.com now, but we don't really check that much. That's mostly just for companies that are startup companies to try and find us, I guess, because we're still interested in doing some investments into startups. But people can reach out. Email's best, I think, just because I don't really answer the phone, and but I always respond. I just sometimes take some time, but I can let email sit there. It's the easiest way, I think, for me.
Cool. Awesome, John. Thank you so much. This has been amazing. I really appreciate you coming on.
Yeah, my pleasure, Jonathan. Thanks for having me.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.